Hi, this is Randy Finney with Right Side of the Chart, and this is early session update for Friday, March 17th, 2023. It is 10:26 Eastern Time as I'm starting the video, so we're about an hour into the trading day. I'll do something a little bit different. I know I cover charts and get very granular, detailed, oriented, go back long-term charts. I've covered that quite a bit, short-term charts. But what I'll do today is just share my thoughts on the market, where we're at or where we may be at. And I'll cover some charts that I haven't covered in a while for you. We'll look at some breadth indicators because that's something I do watch. I don't cover. There's a lot of stuff I watch that I don't cover on a daily basis. I tend to stick to the basics, the raw technicals, support resistance levels, and other developments like that. Let's start out with the charts because that is, of course, first and foremost. We have the S&P 500. There's that uptrend line off the mid-December lows. There's a rally into it, but a slight little divergent high too there. You can see the indicators turned down, made a lower high right there with that higher high. And then, as I mentioned yesterday, just above the trend line, you had really nice resistance. That was still, in my opinion, a very objective shorting level. If you faded it, you did good so far. Now, what I want to talk about here is, the post I got out to you this morning, the moonshot trades. I realize that the vast majority, if anybody listens to my voice, will try to, probably sees the same thing. I see a decent chance. Now, let me just talk on that really quick and get back to that those moonshot trades on Bitcoin and the markets. And I used NQ there, but of course, S&P 500 and Russell 2000, if I'm correct, will fall as well. I'm a very analytical person. I view everything, all my trades, that is, there are two components to that. Number one is the RR, or more so the profit potential. Now, the RR is really, that goes hand in hand, your profit potential. If I'm trading, let's say I'm bullish and long on Bitcoin or natural gas, on those trades, and it's a swing trade, not just a quick trade. Those trades are measured well into the double digits. I mean, both of those instruments can go up double digits in a single day and do it again the next. So you might have a 30% profit. And then the RR, then, if you want to use a reasonable risk-reward ratio, if you're going for a 30% price target, you might use a 10% stop. That's a 3-to-1 RR. You need wider stops on more volatile instruments to keep you in without having your stop run. You can't run a 1% stop loss on a Bitcoin trade or a natural gas swing trade because you're going to get stopped out in the noise, even if the trade goes on to play out. So look at, first component is how much profit potential in a trade. And then there's a second component I factor in, and that's the probability of success. And the way it typically works is, like I said, for that moonshot trade, pretty much what I'm calling for, there would be a crash in the markets. If let me pull it up for you real quick. Okay, that's this one that shows the NQ here. We'll blow it up a little bit. Just going on in between now and Wednesday, selling off. Arrow breaks denote levels where reactions are likely, whether that reaction's a bounce or just a pause, consolidation, and then you take it out, and that opens the door to the next one. And I know, especially with the current trend right now, there's a very voracious and aggressive bid right now, especially under tech stocks, not so much under, you can see again, the S&P's down, small caps are down 2%. The Russell 2, I'm looking at the futures at least, 2% down on RTY, 0.85 on ES, the S&P 500, and the NASDAQ just turned negative, and it's barely. So that is, again, a pretty, it's certainly a counter trend call, because as I said, there's no sell signals. All we have are divergences. We do have rallies into resistance on some things that I've mentioned, such as the S&P 500, which just got rejected. And then, sometime after the Fed's out of the way, because it's been my experience, the market usually will go into a holding pattern leading right up to a big FOMC meeting. So if you're going to get that taper tantrum trade where call it nervous longs getting out, taking profits, or call it the market just trying to tell the Fed, hey, we don't want any more rate hikes. We don't even want a quarter point. We want zero. And then we want you to start cutting. That's what the market wants. But the market doesn't always get what it wants. And remember, the ECB just gave you 0.5%. Now, the Fed kind of led the way. ECB lags the Fed. And so, that's just really a game of catch up. And anyway, we'll see. But here's the thing about it. don't assume come Wednesday afternoon at 2 p.m. whatever the number is, whatever the Fed does and says, don't assume that's what's going to be the lasting reaction. I always say this after an FOMC meeting: the initial reaction, it's almost I'd say it's 100% of the time the initial knee-jerk reaction, if you're looking at the 1-minute charts, is faded. So there's either a quick spike up or a quick spike down, and then that reaction is often faded. Now, the initial one could be the lasting reaction. Sometimes it is, but just quite often it isn't. All I'm trying to say is don't read too much into what the market does initially, unless it just goes on, and either, and melts down through some key support levels. Or at the time, I'll go over the chart, see where we're at. Who knows where we'll be between now and Wednesday? But again, this is my hunch. And although the probability of it playing out is extremely low, I mean, if it was high, you could, you buy a bunch of call options, you'd be very rich. But then options, I'm not a big fan of, because and then if it goes up here, the premium is just going to melt off, and you're not going to get paid for it. Plus, volatility is still elevated right now. You're going to pay for options. So, anyway, that's what I think. It's again, I think I made it clear. The odds of it happening maybe aren't great, but it is. Believe it or not, it's my preferred scenario, and it's one that I'm pressing. I told you yesterday could see maybe a gap up, a gap and crap, or a little pop up this morning, and then fade that. And that's I hadn't planned to add any more index shorts, but I did. I had to. It just this pop this morning just smelled ripe to fade. And anyway, my thoughts. And so this is a scenario that I'll watch. We'll see. We'll do it play by play here. Let me just move on. I already got that out to you. Either trade it, don't trade it. This isn't a follow me site. I'm just sharing my thoughts, and there's a lot that goes into this. It's not just that, hey, I'm going to have a hunch that this is going to be market's about to crash here. I just think there's a decent enough chance that it's worth me taking that shot, because worst case scenario, I'm sitting tight on the shorts I have. Got a pretty chunky position right now, and hey, if they take a little back, fine. I've had a good year so far, but I'm pushing this one pretty good, and I think that's the likely scenario. There's a lot of factors that go into, including not limited to the fact I think there's a very clear, the market's clearly illustrated in the last couple of days to me two things. Number one, that they think that it's over. And if you follow me for a while, you go back for about a year now, a good year, I warned, and I said back then, wouldn't be right away. You'd start to see sooner or later in this bear market, cracks in the financial system. And I've said that repeatedly, and I've stopped saying it lately because it's already started to happen. First it was crypto, various crypto lenders, crypto exchanges. Now it's the banks, and you have that same kind of feeling where the masses think, okay, the Fed's come save the day again. They're going to backstop the banks. It's 2008 all over again. Somebody made that comment yesterday that the bank, when they bailed out the banks in 2008, the market went nowhere but up, and that's very wrong. I'll show you a chart. In fact, they had a very sharp rally. That was, I replied to it. I looked it up. It was TARP, and what was the act? It was an act they passed that really shore up the banking system and the financial system. It was early October 4th, I think. Market rallied for a week or two, and then from there had plunged down over the next, I think it was 4 or 5 months, for another 36%. So, and one of the reasons is, the banks were shored up, but guess what? The reality of it was the fact that the stock market had already fallen. The bubble had already burst. The financial bubble wasn't just a housing bubble, but largely that. And of course, the banks had, shenanigans, and they were when the tide went out, they were exposed just like now. But then where I'm going is we were in a recession because of it. The stock market was already down, people's 401ks are down, they stopped spending. It's a vicious cycle, and we're, again, I think in the early stages of that. So trade it, don't trade it. Again, I'm just showing you levels, and like I said earlier, the only guarantees I ever give you is I'm going to be wrong sometimes. So if you're a bull, these levels I'm giving you here, you're looking, maybe you want to add, you think the market's going a lot higher, you think the bear market's over, you want to buy dips. Each of these are support levels. If we get there, great. And we may never, we start going up much more, we burn out divergences. But let me get to a few other charts that I promised you I'd get to here. All right, let's talk about market breadth. One of the easiest ways, years back, I created, came up with, I'm sure others have used, I shared it on the public site when I used to post a lot of public videos, um, what I call my real-time breath indicator. And I love this because breath indicators, there's various types, but one of the big ones is the number of advancing versus declining issues. And I came up with a way to get real-time breath indicators on any index. First of all, you can't get real-time breath indicators on most indexes. Most are delayed. And then there's usually only the NYSE or the S&P 5. I think they'll give you the S&P 500 or NASDAQ. But I can do it on any index sector using TC2000, for example. Here's QQQ. All you have to do is queue up the related item, the component list, and that's what I just did here. And then you simply sort by percentage change. And so what I'm going to do, and I did this earlier today, and it confirmed what I'm seeing: breadth deterioration. The market's rallying, but guess what's rallying? I kind of went off on a tangent a minute ago. So not only does do the masses believe, based on the recent price action, that the Fed has once again backstopped the system and we're okay, and off we go, no more worries. But there seems to be, and I've noticed, a trend where most of the money has been flowing into not just the NASDAQ 100, the tech stocks, but mainly those big FANGs. Everybody loves those FANGs, and they're being treated now. I've noticed the market's treating them. They are flush. I will say this: Apple, more cash in it, knows what to do with. These guys have stock buybacks coming. I've heard that 100 times, that they can't go down because there's so much cash they have to deploy. But they're being treated like safe harbors. And in a recession, the tech stocks will go down with the rest of the market. They always do. They always have. They tend to get ahead of themselves. And when the rest of the market drops, after a while, they finally get the memo, and then they play catch up to the downside pretty hard. So you can see, look what's green today. And here's how my real-time breath indicator works. So since I did it, I changed. I got to go back. So as of now, here's NASDAQ 100. Let me tell you where it's at. QQQ. QQQ is almost flat, down 0.38, right? Earlier it was positive, and I did this. I click right here. See, these are the green ones, percentage change. And that tells me down below, you can't see it in the video most likely unless you're looking at a big monitor, 12 out of 98 items, so roughly 100 stocks. There's 100 in the NASDAQ 100, but it's, different share classes and all this. And but either way, that's telling you that only 12 stocks, the market's just slightly negative, are positive. And that means that, or you do it the other way around. If you want to know how many are negative, go here and then scroll down to the last red one. They're changing, so I'm just going to click on paychecks. It tells me that 84 of the stocks are down. That's been the trend lately in the last few days. What does that mean? Well, it just means that's not a healthy rally. It tells me that only a few stocks, fewer and fewer, the majority of the stocks are not going up in the NASDAQ 100, which has been by far the strongest index. Other people are just chalking, the S&P, it's got a little worries right now with the banks, but that's it. That's what's holding it back. No, every other sector, like I've said, bear market is for the rest of us. Industrials, energy, the rest of it's, the reapers come out and got those other sectors already. They're starting to roll over their charts. They're off the highs and they're coming down. They're leading the way down. So we're at that stage in the bear market, I believe, that this is just another hopium round, another bear market rally. And those are my thoughts. Now let me show you additional evidence here on a couple some of the breadth indicators that I was going to talk about here. So we'll go here, and I need to go to let me move this thing up. You can't see it up here. I've got a lot of them out there. There's a gazillion breadth indicators. This is one. This is the NAHL. That's the NASDAQ New Highs to New Lows Index. And let me change my color here of this tool to something we can see. I love this indicator, and it's very hard to make out in this video, but there are two lines there, a red and a blue one. The blue line is the NAHL, the New Highs to New Low Index, and then I use a 20 EMA, exponential moving average, and you can see, and this shows when they cross over, basically when the NAHL is above its 20-month, the trend is bullish. These are all lines in the past I've showed where the crosses occur, and you can see I created a custom histogram that shows when those two cross. So this is not a MACD. Forget that it says that. I have to tweak sometimes go in and tweak the settings. I figured this out years ago, how to use a MACD, change the settings on any two, using any security, any index, and then putting up a moving average, and then the histogram will simply show when the moving average crosses over or under. And so yeah, and I would have highlighted this back at the time when I was calling for the top, this bear market that started at the end of the bull. There was the last one there. You can see all the big corrections in recent years and bear markets and COVID and the fourth quarter 2018 drop. They all early on, this fired off a sell signal. It works pretty darn well. You can see again, this helps show you that the when the NAHL is trading above the 20-month, and when it's trading below, you're in bear market correction mode, right? You can again see these little boxes. This one fired back here, and it has been dang reliable, just like my 200-day moving averages, just like my 20-month exponential moving average, all those other long-term things. And this has nothing to do with those. But it said, hey, you're in a bear market. Get out of your 401k or short and stay short if you're a long-term trend trader. Now, you know me, I gain the little counter-trend rallies, but look what each one comes back to here. We're still below there. And again, this is a zoom in right here. So you can see there, we had a crossover. By the way, this is a breadth indicator. Once again, it's not just a great trend indicator for the longer term swing trends. It is a breadth indicator by showing you the ratio of new highs to new lows, right? And so this is telling you in the NASDAQ what I just said. Most of the stocks are still making new lows. They're not making new highs, despite, and even in the last couple days, this should have turned up, right? So there it is. So that's why I see things that most don't see. Maybe I'm going to be wrong, but I'm saying that this is a sucker's rally, I believe, and one that I'm comfortable shorting into. This one here is the NASDAQ advancing versus declining line, and I've used this to sniff out some major tops. This was the last real bear market, in my opinion, the 2007 to 09 bear market. I haven't visited this chart so long I need to expand the time, but you can't just scroll. I've got to go in and change it. But I can just tell you, I had arrows there. You can see they're the shaded arrows, and I look for divergences. So when the NASDAQ advancing versus declining line is dropping, meaning more and more stocks are declining than advancing, and that's what happens at the end of these bull markets and even rallies within a bull, even trends within a bull market. When that starts to happen, what's happening again is fewer and fewer stocks, i.e. think the FANGs here, are doing the heavy lifting, and the majority of stocks in the NASDAQ are falling. And that's a red flag. So in other words, down here on the bottom is the NASDAQ. So then when the NASDAQ's going up, as it was to the left there, right into the highs in October of 2007, and you saw this line diverging, that was boom. That was, hey, there's a problem. That's again, we'll call this market internals, poor market breadth, or what I call market halitosis. There's another little warning sign, boom, correction. You can see that big divergence there. Again, the number of advancing versus declining stocks. Market kept going up, ignored it, and this was one of the biggest corrections up to that point in time in the bull market. Right there, right leading up to COVID. COVID, I've said repeatedly, was not a random event. There were so many technicals saying the market was going to correct or go into a bear market, and it did, and just one that the Fed truncated, not just the Fed, DC as well. And then you can see this leading up to the end of this bull market. Remember, the NASDAQ peaked right here in November of 2021. The S&P and everything else peaked right after that, and there was clear deterioration in the market internals. Okay, where am I going? Okay, Randy, we know that's hindsight stuff. Well, it was pointed out then, but I also will point out there's been a sharp drop off here since, remember that New Year rally? We got long, we caught most of it, right? With the big fangs. Market shot up, the NASDAQ shot up, and so did the advancing declining line, but look what happened recently. It's been a sharp drop off, much sharper than the little correction. Again, this is a weekly chart, but you can see that market breadth just isn't supporting. There's a lot of stuff, in my opinion, that doesn't support a market bottom and indicates this is nothing more than a bear market rally. I'll give you just a few more. We're not going to go over a gazillion. No point to do that. Let me pause the video and queue up. I got about 3 or 4 more charts for you. Here's another one I like and reference from time to time. NAHLR. By the way, I'm using stockcharts.com for this one. These charts, Nasdaq new high to new low ratio, and this is a weekly. So it's a line chart, and they basically just snapshot at the end of the week. And you can see this line here. I've had it here forever. I've shared this one in the past. Again, not recently. That's where corrections end. The blue line marks the end of corrections, and bear markets typically go way lower. This was the last real bear market, and that's what happened there. These were all the corrections within the bull market that, in my opinion, started in March of '09. If you're looking at the bigger picture, there's still some trend lines. Yes, I have moving averages. Yes, I've made a case we're in a bear market, but there's still some things you can say that some trend lines, longer term stuff that haven't yet been taken out. Whatever, semantics again, whether bull bear market, we know we're in I'll call it a big major correction or call it a bear market, call it whatever you want, it really doesn't matter, we know what the trend is. But you can see here, this line's worked very well. And again, this is since 2009. All the big drops, by the way, they're all in here. You can look at your own charts, mid 2011, that what I call, that was a year and a half of a down to sideways market, culminating in or late 2015, early 2016, with two big drops, close to 20% on the NASDAQ. That ended there. That's at the end of it right there. That told you, hey, it's over. Big Q4 2018 drop, boom, hit it right there to the button. COVID, boom, tagged it to the button right there. Overshot those a hair, but again, you have to hit the line. We've never hit it yet, and so this is one of many things that again keep me kind of unwavering on the fact that we're in a bear market that will, number one, and this is where I think the fallacy of a lot of analysts and people out there, recency bias. I think this one's going to be a lot different. I know you've heard me say it 100 times, but much longer. I think it's going to be an extremely profitable market to trade, because I think we'll be in a new secular or larger bear market, but within it, there'll be plenty of rolling bull markets, rolling bear, rolling bull markets like we've had so far. And, hopefully we'll try to get in front. Get out of our swing and trend shorts and game some of those rallies on the long side. Maybe even 401k investors, you can move to cash when the bull market or the bear market rallies appear to have run their course, scale out, scale in kind of thing, and catch these rallies, because they're all double digits by the old definition. 20% gain or more from the lows, they're bull markets. But to me, again, they're bull markets when they're bear. And you can see we've come close, but we haven't hit that line. And yet this is the biggest drop since back the last bear market. This chart may appear to be deceptive to many. I'm not using log scaling here. So that was a 55+% drop in both the NASDAQ and S&P back there. So, and this wasn't. It's just, this is what happens when, again, I didn't have log scaling turned on. But anyway, that's one I wanted to show you there. And I've got a couple more here and we'll wrap up. Oh, and before I leave this one, you can see there's been a little spike up in the new high-low ratio, but not concurrent with this, and really nothing indicative of a bottom. Just again, to me, nothing more than a bear market rally, which again I'm pushing hard on the short side right now. Okay, and then one other type of breadth indicator is to look at the percentage of stocks in an index. In this case, down on the bottom here, right here, we have the percentage of stocks in the S&P 500 trading above their 200-day moving average. So the way you use this chart is you have a midpoint right here of 50 right there. And so when you're above that line, you can see the numbers. It's bounded by 100 and 0, because you can never have more than 100% of the stocks trading above their 200-day, nor do you ever get that high, but you can get in the upper 90s in a strong rally, like the last time we saw that a couple times is after COVID, with all that excessive government intervention, and the end of early, right after the last bear market was over in 2009. So rarely do you get up that high, and that again, that usually it's a strong signal. It's not a sell signal. It comes off extremes. But the one takeaway I have here, well, a couple you can see right here, as I say, divergences between the S&P 500, which is up top, and the percentage of stocks trading above their 200-day moving average are often followed by substantial corrections. And this is, again, these are things I've covered in the past. That was the last end This right here was the end of the last bull market. That was that 55 or so percent drop in the S&P 500 from October of '07 to March of '09 right there. And you can see clearly the market was rising up into the October highs, all-time bull market highs, while there was a sharp drop off in the number of stocks trading above or below their 200-day moving average. And then again, you can see I have all the divergences and all the corrections marked. Again, there's COVID right there. That one was not really so much of a divergence line because, yeah, it was slightly higher high, but close, really close. But this one, this was, I mean, the writing was all over the wall on this one here. Look at that drop off we had into the highs. And again, I covered this back then. And here we are. Okay, so great, Randy. We know that now. You're right, but what else is there? What other useful information going forward might we be able to extract from this chart? Oh, glad you asked. Right here. This line. This is where bear markets, at least in recent years, have ended. You can see 2009 and COVID. Those are the only, where most, the consensus is they were bear markets. COVID was 36%, and this one was 56%, the S&P 500, right? And that's where bear market ends. These, when you come down here, this including these two, that's where corrections end. So, look, no one indicator is 100% effective, and over time, maybe this happens. Maybe we go on to take out the new highs, and this mark the end of a bear market. And then guess what? This indicator or my analysis based on this one chart will be wrong. But unless this is where I will be, well, it's hard to, I was long here and I was long here. So, but I will most likely be long there, but not necessarily on the initial tag. Things have to get ugly. And that's kind of what this chart shows me by just about all these long-term indicators, that things, as ugly as they might feel to you if you've been on the wrong side of most of this bear market, we haven't seen that capitulation like we've seen in previous bear markets at all. And this is so far the most powerful bear market we've had since 2007 to 2009. So again, it would just be very atypical for this to mark the end right here, the October lows, to mark the end of the bear market without so many of these previous sell signals, or I'm sorry, buy signals, capitulation. This is capitulation right there, and they're extremes too when you see that number of stocks. So, and then you can do the same thing with the Nasdaq 100. My bad, let me stand corrected. Nasdaq Composite, I believe this uses the Nasdaq Composite. All the stocks in there, it's going to be the same difference they track together. And you can see again, it was clear. The writing was on the wall leading up to the end of the last bull market in 2007. Then you dropped and you didn't bottom till you got down there, and you even had some divergence. So again, it wasn't the first tag at that level. So what I was trying to say a minute ago, that doesn't necessarily mean I go long and all into my 401k, because there was still a lot of meat on the bone, just like that comment I made earlier when someone, and I'll show you that chart here in a second, and then we'll wrap up, where when the Fed came in and the government just saved the banks in early October of '08, there was still a lot more downside to go. So that's why these rallies, where the masses think, oh man, great time to get long, or the government's backstopping the bank. Someone sent me something last night. That's some guy on TikTok or something, and he's declaring this is the next quantitative easing. He was comparing it to COVID, when COVID hit, and basically saying that this is akin to a new round of quantitative easing. So, and the market's going to explode from here anyway. So we'll see. He'll be right, or I'll be right. One of us, not both. This is where COVID ended, to the button. Okay, so that's this is the Nasdaq. We're just looking at the S&P. And so far, we got close, and we went long there, and we covered shorts. I made that clear. That was a pivot into in the beginning of the new year, and that was October. We also gamed that one. There was the new year right there, and you had some divergence, and it's certainly been good for a rally. But again, we went to so far where previous corrections. These are where corrections, 20% drop. You can see them all measured, 17.5. 25, 30 in the Nasdaq. It was 36 in the S&P, and that's about where we fell to recently. All right, last but not least. Okay, this is a chart I was referring to. This is where TARP came out, and the plan, I forget the name of it now, to save the financial system. And you had a powerful rally. And you can see it was very short-lived. This is just a daily chart. That was it. What was it? Maybe good for a couple days even. Kind of like now, maybe we'll see. And it was, hey, you didn't want to be short that rally. I'll tell you what it was, just so you know. Or actually you did, like me. I rode this thing out and used the rally to add to some short positions. That one was 23, 24%, and there may have been, again, might have been some reason, but that was powerful stuff. But then look what happened. A measure from there, going down, and that was early October. So from there, if you bought in and figured that the Fed saved the day, and just because the banking system was backstopped, that we couldn't go down anymore and it was time to buy stocks. Well, you can see from I don't know if you can make it out on the very left, to the left, take that horizontal line where my crosshairs are, it says 30, that's a 36% drop. And that went from October all the way into March. And that is, as I said in that reply yesterday, that comment section, because the recession was already this. This is what causes a recession. More than anything, two things. The two biggest components to consumer wealth and confidence are those that, there are the haves and the haves not in this world. All right, I don't want to get all political about it, but the have-nots don't have 401k money. They don't, they live paycheck to paycheck for the most part. I'm being a little binary here. And then the haves, most of their wealth is in their home and their investments, the stock market, the 401k, and their other investments. And those two go hand in hand. I've never seen a point in history, or at least I'm not familiar with, where you had a bear market and then the housing market was still soaring. This time it's holding up somewhat, but it's certainly rolled over by every metric. I covered that recently. And so it just takes time. When you get down here, there's that point where, it's been, a year, time goes on, people's 401ks are down 20, 30%. And it's a vicious cycle, the wealth effect. They stop spending money, they see their house value going down as well, and then the recession comes. And so, again, this was back then, and I just wanted to show you that, backstopping the banks, who knows? Hindsight will tell. If the market's going to go up substantially from here, I just don't think so. And as such, I'll recognize that we're not in any type of, the markets are still above this Monday's lows, and the Nasdaq's still above its 200. So it's still not an all-in short moment, at least not for trend or swing traders, where you can kind of short and tuck away those shorts and throw away the key. But I'm trying to sniff out the cracks, whereas we can all play the glass half full, glass empty. Glass half full, yeah, tech stocks, the market leaders are rallying, but I already explained that again, how that's very unhealthy. I think there's a misplaced trust in those stocks because they are so well capitalized and they have nothing to do, quote unquote, with the banking system. But this is the one we shorted yesterday. First one I threw out to Mbia. This is one of, I believe, the biggest municipal bond insurer. So there's something rotten in the state of Muniville here. If this stock's crashing and with no end in sight, and we're getting close to our first target. And no, yeah, is it a trade? Yeah, we'll make maybe hopefully a few bucks on this. But it's also, to me, speaks volumes where an aspect of the market that's not being talked about or watched right now. Again, I can shore up the banks. I use the analogy of the Hoover Dam, big dam full of cracks, fissures that continue to build. Fed's taking fingers, plugging it in. They just plugged the regional banks. Credit Suisse, from what I understand, is down again today after the massive bailout by the European Central Bank. And these are the things to watch. Just keep an eye on this. KRE, regional banks. If we look at what's going on today, government, quote unquote, saved the regional banks, but look at FRC, First Republic. I'm just going through a list of some of these that are down. Pac West. These things just aren't looking good. And then you got to watch other sectors too. Schwab, the brokers. Schwab's in a very precarious technical posture. That was big support right there. I mean, a lot happened in Schwab. First and foremost, charts told you a long time ago you should get out. That was a beautiful bearish rising wedge breakdown, textbook back test, been walking lower, big support right there. Then you took out more recently when all these shenanigans with the banks happened. It rallied back to resistance, and then another divergent high right there, a lower divergent high. This is what a bear market looks like in a stock. Everything peaked early 2020, most things did, and stair-stepping lower, and then boom, when it broke that support, that's a well-defined trend line, it just waterfall sold off. And here's the thing, it remains below, that's big support right there, and it snapped back up. Everyone thought the Fed saved the day, and maybe they did, maybe they didn't. Now here's a level, we overshot that briefly. If we get under there, then you gotta start, keep an eye on these brokers. Look at, I don't use Schwab, but I have quite a bit of money with Interactive Brokers. And yeah, this is, as of now, still trading. There's, and I have money spread around a couple other brokers, but, I'm watching this. There's a secondary trend line right there, but this was a powerful breakdown here. And this kind of breakdown, you can see have quad highs, 1, 2, 3. Actually, it goes back. There it is. Look at that level on Interactive Brokers at about $80. Quad highs, breakout recently, just like the stock market broke out of key support. With the stock market, it was the downtrend line, the S&P 500 in the 200 days. But when it did it, this is why I don't chase or I short breakouts that occur with negative divergence. I had negative divergence. Not that I traded Interactive Brokers. I'm not saying I took this one. I'm saying that was one. Had I been paying attention to it this time when this trend line broke, that was short entry number one, object in a powerful sell signal when it fell back below here, because as I often say, fewer things, if any, in my opinion, are more bearish in investing and trading than a failed bullish breakout. Breakouts to new all-time highs are on face value one of the most bullish things out there, and I've said that before. The reason is every single buyer or holder of the stock at that point is profitable. Not a single person, technically, generally speaking, forget about day traders and out, but holders of the stock, everyone's profitable. And so breakouts to new highs, often if they don't have divergence, they're good things to buy, and mostly get a back test and go off. But when they fail, that's called a bull trap. All those that bought the breakout are now underwater. Their stops have been and will continue to be hit. And again, it's that was resistance. Once broken, right here becomes support. So it was support, but now we broke it. So now it's resistance again because we're back below it. And so any rally back up to the 80-ish level would be an objective short entry on Interactive Brokers. All right, guys. And again, these are the other things. Again, the regional banks are important. They're big, but we're creating a lot of imbalances. In the financial system. Tons of moral hazard. The big banks, the massive colossal banks, have become a beneficiary of this. There's a lot of money moving out of the regionals. You probably saw that Silicon Valley Bank, the holding company, they stripped out the bank, put in FDI, took that over. The holding company declared Chapter 11 bankruptcy today, which means basically the shareholders hold the stock, and there's a ton of preferred stock, billions of dollars, bonds too, and they say there's been a lot of buying from hedge funds and institutional those bonds recently. Well, the way it works, if you don't know, and I know I'm talking, when a company files for bankruptcy, there's a hierarchy. And it's up here is and this is how, in order to get paid, you have the creditors first. Those are your bondholders. Below the bondholders are the preferred stockholders, then the common stockholders. They're at the bottom of the rung. So bondholders must be paid off first if there's anything left over. If a bad bankruptcy and there's nothing left, bondholders get nil. Sometimes they get 80 cents on the dollar, 50 cents on the dollar. Sometimes they get 100 cents on the dollar. Once they're paid off, then the preferred stockholders. If there's anything then left over, that goes to the common stockholders. So in most, like this case, I haven't looked into the details. You would imagine the common stockholders are going to get wiped out. Probably a good deal of the preferred stockholders. And these things have repercussions. This isn't the only bank or only institution. So we'll see what the longer term fallout is. All right, I've talked enough. You guys know the levels to watch. Where I think might happen. And then look, at the end of the day, if what I think happened doesn't play out, I'm going to watch levels. And at this point, I'm really, I have my fill between now and next week, enough shorts that I want to have. I'm more concerned at this point about scaling out than I am on. Again, I'm speaking to trend and swing positions, not active trading. I may be probably between now and next Wednesday at 2 p.m. when the Fed goes, I'll probably be in and out of NQ a dozen or more times, active trading off levels on short-term charts. And but swing positions, like I said, I plan to hold, and unless they start to stop me out, and I'll do that. Usually I do that incrementally, gradually, not all or none. All right, I'm going to wrap it up here and get the video out to you guys, and I'll continue to hunt for new trade ideas and anything else that I come across that I might have missed. This has been Randy Finney with Right Side of the Chart.